All right, welcome back to the final round here on Yahoo Finance. Miles Eldon with you in New York. Let's turn to the markets now. We're joined by Jim Bianco, President and CEO at Bianco Research. Jim, always great to get your thoughts. Let's start with an area of the market I know you follow closely. That's what's happening in gold. Just a tremendous move in metals, not only today, but over the last couple months or the last 2 years. What have you made of the run up here? Gold above 2,000. And then does today's kind of sell off do anything for you, or is it to be expected, I guess, given what we'd seen running higher?
Well, it's not to be expected. It's a 6% down move. You know, you got to go back a couple of decades, and you're going to find a handful of such days like you're having today in gold. So it's a big down move. Now, if I put my technician's hat on, I'd say that after the big run up and the run down that we've had in gold, I don't think we've broken any trend lines, but we've come right back down to them. And let's add in that it isn't just gold that's moving today. You're having a big up move in bond yields. You're having a rally in the dollar. They're all somewhat related to each other that you would normally, in normal times, in pre-pandemic times, call this a risk-off move. Risk-off move. But yet stocks aren't really enjoying what you would expect them to be benefiting from such a move as everybody gets out of gold, gets out of bonds, towards stocks as well. So it's been more of the post-pandemic confusion we've gotten so far.
Well, and speaking of those interconnected macro trades, so, we've got the dollar, we've got treasuries, gold, and as you mentioned, today's specific price action would suggest a risk off. I would actually kind of bounce this idea off you. With the NASDAQ selling off, isn't that also risk off? I mean, hasn't the NASDAQ been a safety trade of sorts in this market? Is that a fair characterization of how the FANGs have played a role here?
Yeah, well, all the FANGs are basically, you're right, they are safety trades because they are the stay-at-home stocks, and that's where you want to hide if you think that we're going to continue to have some kind of a problem as well, too. So you've got a lot of that would have suggested that if you were to just show me what the FANGs are doing, what gold's doing, what bonds are doing, what the dollar's doing, I would have said to you, the Russell 2000 type of stocks, the non-FANG S&P stocks would be having a monstrous update today, but they're not. And so that's where I think the confusion comes in just yet on what we're seeing in the market.
Jim, Dan Roberts here. I know we're talking about gold and the impact there, but also as we see markets turn negative within the last hour or so, we have the big news about college football. First, the Big Ten, and now actually breaking just a moment ago, one of our colleagues at Yahoo Sports, Pete Thamel, saying that the Pac-12 has followed suit with canceling the fall season. I would think you wouldn't necessarily see a direct impact from college football news on the markets, but you think differently. We were talking in the break about this. Give us a little bit on the impact you think.
Yeah, I mean, having college football in the fall is a sign of normalcy returning, especially for a lot of the schools that you have college football in the Pac-12 and the Big Ten. They're not in the major media markets. This is not Chicago and the Giants and the Patriots that we're talking about. We're talking about some of these other schools, and it's a sign, it's an indication to everybody in those neighborhoods or in those states that things have not returned to normal yet. And as much as we want to believe it's going to return to normal, and that has definite impact on the election as well, too, that it is telling you that it is. Now, the big one in college football is the SEC. From Florida all the way to Arkansas, all the way to South Carolina and Clemson, which is there as well, too. They haven't said anything. But I think if they were to delay till the spring as well, too, that could actually bleed into the election, too, because you'd be telling everybody in that important place for voting, it ain't ready yet. It ain't right yet. And that's what I know the Trump administration wants everybody to believe, that we're on the way to getting better, and that would be an indication that we're not.
Hi, Jim. Just turning back to the sort of rotation that we're seeing over the past couple days, over the past week into cyclical value, taking a look at those financials, industrials, materials leading the way higher today. This isn't something that we've seen. This isn't the first time that's happened. I think at the end of May, beginning of June, we also started to see this and that sell-off in big tech. So how resilient do you think this rotation is right now? How long do you think it's going to extend? And what might serve as a catalyst to send things going back the other way and back into tech and back into these other names?
Yeah, I'm going to be a little bit skeptical that this is going to be a real rotation into those names. I think what you're seeing in financials, to use one example, is a knee jerk of higher rates, wider yield curve. That's supposed to be good for them. The algos say, okay, it's time to buy financials. But I don't think it's anything more than just that. I think what could really upset this, and this is what I've been worried about, and this is probably not next week or the week after, but looking down the line, is higher interest rates. I mean, much higher interest rates. If the 10-year yield's at 62, 63 basis points right now, and it makes a run towards 1% towards the end of the year, or maybe through 1%, 175 to 2% on the 30-year, I think the story then becomes that inflation is an issue. That's why you've got dramatically higher yields if you get that. And that will be problematic for risk markets, especially the cyclicals and everything else, because they're dependent upon the economy recovering. And I don't think that, they can just default back to, well, inflation's going up and we're a cyclical company and that should benefit us. No, you need the minus 32.9% GDP to go positive is what you need is just cyclical. And higher rates could really put the lid on that, and that could be very bad for them. So 62 basis points isn't a problem, but we rejected 50 on the 10-year note just the last week. Mm-hmm. And if we continue to see rates move higher and higher, I think that can be a problem over the weeks and months ahead.
And then, Jim, quickly before we let you go, we haven't really talked about the virus. Like, we've talked around it, but not explicitly. As we look at case counts, a couple months ago, we would have said every tick might be moving the market. That hasn't really been happening for a while. Do you expect that to come back into play as we head towards the fall, or has the market made peace with the virus?
No, I expect it will come back to play as we head in the fall. Right now, the virus count has peaked. It's been heading down, except in the upper Midwest where I am. It's kind of showing some resiliency, but at lower levels as well, too, as it's starting to move up. But I think a lot of people have really concluded that whatever the virus has done, it's over with for now. When the weather turns in the fall and we all go back inside, think of this as being an indoor disease where we all breathe indoor air and pass it to each other. Then we'll all have to wait and see whether or not we get an uptick of the virus in the fall. And then that will really tell the story. But for the next few months, I think you're right. I don't think we're going to be as focused on the virus count, at least in the United States, as we have been, say, over the last 2 months.
At least until November 4th, because everything up to the 3rd, of course, we all know what leads to that. All right, Jim Bianco, President, CEO, Bianco Research. Always great to get your thoughts. Thanks so much for joining the show.
Thank you.